Your accountant, your realtor, and your parents all told you the same thing, and none of them were lying to you, but they were all leaving out the part that changes everything. There's a tax benefit that millions of Americans use to justify buying a home they can't really afford, and the actual math behind it, not the version they walk you through at the mortgage office, is one of the most quietly devastating financial illusions of the last 50 years. I ran the numbers, the real numbers, and what I found honestly made me a little angry, because once you see it, you can't unsee it. And it explains so much about why homeowners with six-figure incomes still feel completely broke.
My name is Robert,
And I spend probably too much time obsessing over the systems behind personal finance, not just how they work, but why they exist, who benefits from them, and why the same advice gets recycled over and over, even when it doesn't actually hold up. I want to be upfront about something before we go any further. I'm not here to tell you home ownership is bad. I'm not here to argue you should rent forever. What I am going to show you is that one of the most celebrated financial perks of buying a home is built on a calculation that almost nobody ever actually does. And the reason nobody does it is kind of fascinating and kind of infuriating. Here's what we're going to cover. I'm going to show you the specific way the deduction gets sold to buyers and where that pitch quietly falls apart. I'll introduce you to something I call the amortization trap, which is the thing nobody mentions when they're handing you the keys. And I'll get to the question I kept asking myself when I first looked at this. If the deduction is so valuable, why do the people who benefit most from it keep feeling financially stuck? But first, let me tell you about a guy named Marcus. Marcus was a high school teacher. Solid income, good savings habits, mid-30s. He'd been renting for years and finally had enough for a down payment on a $400,000 home. Everyone in his life was thrilled. His mortgage broker sat him down and walked him through the numbers. At a 7% interest rate on a 30-year loan, Marcus would be paying about $2,100 a month. But here's the exciting part, the broker said. In that first year alone, about $27,000 of Marcus's payments would be pure interest. And since Marcus could deduct that interest from his taxable income, he was essentially getting a tax break worth thousands of dollars. It was, the broker said, like the government subsidizing his home purchase. Marcus felt smart. He signed. And here's the thing. Everything the broker told him was technically true. The mortgage interest deduction is real. You can deduct the interest you pay on a home loan from your taxable income. It's been part of the tax code for over a century. Millions of people use it every year. But here's where it gets interesting, because what the broker didn't walk Marcus through was a slightly different question. Not can you take the deduction, but how much is it actually worth to you in real dollars, in your real tax situation, compared to what you would have gotten anyway. That distinction is where the whole story changes. And this connects to something I'll show you in a few minutes that completely reframes the way this benefit gets talked about, something called the standard deduction that most homeowners don't factor in correctly. Keep that in mind. Here's what I mean. Let me show you how the deduction actually works in practice, because most people, including people who've owned homes for years, have a genuinely fuzzy understanding of this. When you file your taxes, you have two choices. You can take the standard deduction, which in 2024 is $14,600 for a single filer, or $29,200 for a married couple filing jointly. Or you can itemize, meaning you add up things like mortgage interest, state and local taxes, and charitable contributions, and deduct that total instead. Here's the critical part. You only benefit from the mortgage interest deduction if your itemized total exceeds the standard deduction. If it doesn't, you were getting the standard deduction anyway. The mortgage interest deduction is literally worth nothing to you. Back to Marcus. In his first year, he paid about $27,000 in mortgage interest. He also paid roughly $5,000 in property taxes, so his itemized total totaled around $32,000. He's single. Standard deduction would have been $14,600. His itemized amount is higher, so he does benefit. So far, so good. But here's the thing nobody talks about. The actual benefit isn't $27,000. It's the difference between $32,000 and $14,600, which is $17,400. That's his real incremental deduction from owning the home. In his tax bracket, that saves him maybe $3,800 a year, about $317 a month. Marcus is paying $2,100 a month. His real tax benefit is $317. That is the number his broker should have written on the napkin. I want to sit with that for a second, because we talk about the mortgage interest deduction like it's this enormous financial superpower. And in practice, for most middle-class buyers, it's worth a few $100s a month at best. And for a huge portion of homeowners, especially married couples, the standard deduction is already so high that the mortgage interest deduction is worth exactly zero. Here's the micro insight you can use right now, today. Before you or anyone you know buys a home, run this specific calculation. Take projected mortgage interest plus property taxes. Subtract your standard deduction. Multiply the difference by your marginal tax rate. That is the real value of your deduction, not the gross interest number, the marginal benefit above what you'd get anyway. But there's still one piece missing, and it's the piece that makes this whole thing feel almost designed to confuse you. I want to talk about something called amortization, because this is where the math stops being just surprising and starts being kind of dark. Here's the thing nobody talks about when you're sitting across from a smiling mortgage broker, feeling like you're about to do the responsible adult thing. In a 30-year mortgage, your payments are structured so that in the early years, the vast majority of every payment is interest, and almost none of it is reducing what you actually owe. On Marcus's $360,000 loan, in month 1, roughly $2,100 of his payment is interest. About $50 reduces his principal. Month 1, he's billed $50 in equity. $50. By year 15, that balance shifts. By year 25, he's mostly paying down principal and paying very little interest. What that means for the deduction is this. The deduction is most powerful in the early years when you're paying the most interest, but it decreases every single year as you pay down the loan. The benefit isn't flat. It's quietly, steadily declining. Every year that passes, you're paying a little less interest, claiming a little less deduction, saving a little less on taxes. Now here's the counterintuitive part that genuinely stopped me when I first mapped this out. The conventional wisdom is this. The longer you own a home, the more you benefit from home ownership. Equity builds, wealth compounds, the investment matures. And in some ways that's true, but the deduction argument actually runs in reverse. You get the most tax benefit in year 1 when you have no equity, when you're dealing with surprise repair costs, when your finances are most stretched. And you get the least benefit 25 years in, when the loan is almost paid off and you're paying almost no interest at all. The deduction is front-loaded on the most financially stressful years of ownership. And because it shrinks quietly in the background, most homeowners don't even notice it's happening. I used to believe that deduction was a steady, reliable benefit that made owning a home more affordable year over year. Then I mapped it out on a spreadsheet, year by year, real deduction value by real deduction value, and I just stared at the screen for a while. Now, this is where everything I've been building toward actually comes together. Because there's a question I planted at the very beginning that I still haven't answered. If the deduction is this limited, why do smart, financially literate people keep citing it as a major reason to buy? Why does the myth persist so stubbornly? The answer is something I think of as the illusion of the gross number. When your mortgage broker tells you that you'll pay $27,000 in interest this year and that's deductible, $27,000 is a big number. It sounds like a big benefit. It's meant to. But we've already seen that the real marginal benefit might be $3,800. The gap between $27,000 and $3,800 is doing enormous psychological work, and nobody's calling attention to it. Here's the thing about how we process financial information. We anchor to the first number we hear. The broker says $27,000. That number lodges in your brain. Everything after it, the standard deduction comparison, the marginal calculation, the amortization schedule, is just noise competing with that first impression. This isn't a conspiracy. I genuinely don't think most realtors are sitting around trying to trick buyers. But there is a structural reality here worth naming. The people who benefit from home sales, agents, brokers, lenders, get paid whether you understand the math correctly or not. There's no commission adjustment for giving you a clear-eyed deduction analysis. The incentive to be complete is just not there. So, what do you actually do with all of this? When you're evaluating a home purchase, stop asking, "What's my deduction?" Start asking 3 questions instead. 1. Will I actually be itemizing, or does the standard deduction beat my total anyway? 2. What's the marginal benefit, the difference above my standard deduction times my real tax rate? And 3. How does that number compare to what a disciplined renter in a similar financial situation would be building instead? That third question is the one that quietly restructures the whole conversation. Because the money going toward a down payment, closing costs, and the interest premium over renting has an opportunity cost. It's not just the deduction you're evaluating, it's everything you're not doing with that capital. There's one last thing I need to tell you, and honestly, it's the most important part. Remember Marcus, the teacher who felt smart signing those documents? I modeled his situation over 10 years. His cumulative real tax savings from the mortgage interest deduction, the actual marginal number, not the gross interest, came to about $28,000 over a decade. That's meaningful. That's real money, and I don't want to dismiss it. But over those same 10 years, he also spent roughly $19,000 on maintenance and repairs. He paid property taxes that, after accounting for the deduction benefit, still came significantly out of pocket. And he needed his home to appreciate by at least 3.5% annually just to break even with a disciplined renter who had invested the equivalent of his down payment and monthly cost differential into a basic index fund. In some markets, that appreciation happened. In plenty of others, it didn't. The deduction didn't change that math either way. Here's the thing I'll admit out loud, because I think it's important. I bought into this narrative for a long time. I grew up hearing that renting was throwing money away, that the mortgage interest deduction made buying the financially obvious choice. I didn't question it because it came from people I trusted, people who genuinely believed it themselves and weren't trying to mislead me. That's actually what makes this hard to talk about. It's not bad information spread by bad actors. It's incomplete information that spreads because everyone repeats what they heard, very few people run the actual numbers, and the financial and social incentives all point in the same direction. If you've made it this far, you're clearly someone who actually wants to understand how money works, not just feel good about a decision already made. That instinct is genuinely worth protecting. Here's what I'd suggest. Not don't buy a house, not the deduction is worthless. Just this. Run the real calculation before you sign, not after. Find the marginal number. Compare it honestly to your alternatives. Make the choice with your eyes open. Because the mortgage interest deduction can be a real, meaningful benefit for high earners in high-cost markets, on large loans, when the math genuinely adds up. But it can work and it automatically works for you are two very different things. And for a significant portion of the people who cite it as a reason to buy, it's either far smaller than they think, shrinking every year without them noticing, or it doesn't apply to their situation at all. Go back to that number the broker wrote on the napkin, then go find the real one. Once you know how to do that, you'll never hear this argument the same way again.